The more credit you have, the better your credit score, right? Not exactly. Ted's here. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Okay, Ted, so is it true that the vast majority of our clients here at Hoyes Michalos and Associates, which we named after Hoyes and Michalos, want to complete their consumer proposal or bankruptcy and rebuild their credit so they have a higher credit score?
Yep, that pretty much nails it.
Pretty much everybody. And whether you filed a proposal or not, you want a higher credit score. That's just a universal truth of Canadian
More
life.
is better.
More is better. Okay, so that's today's question. Is it true that the more credit you have, the higher your credit score? So am I going to have a higher credit score if I have 10 credit cards instead of 5? Like, well, walk us through this.
So that doesn't necessarily follow. There's a lot more to it than that. First, most important thing on your credit score is your payment history. So do you make the required minimum payments every month? Do you pay things on time? That's going to have the most positive effect on everything in your credit score.
Yeah, and we do not know what the secret formula is.
Well, and every company has its own secret formula.
It all gets tweaked and whatnot. The general consensus, if you go on to the Google and type it into the AI, is that your payment history, what you just said, represents a little over a third of your score. That is the single biggest component. So you pay your bills on time. That has a big impact.
Okay.
And it also means that the more recent events have a bigger impact than something you did 5 years ago.
Ancient history.
Okay, so number one, payment history. Okay. Tell me number two.
So number two is utilization. So this kind of plays into your whole question of, have I got more credit? I'm going to have a higher rating. Well, utilization is how much credit have you got permission, authorization, approval to use versus how much have you actually used of it. So example, I got 3 $10,000 credit cards. My total amount of available credit is $30,000. If I've used $10,000 worth of that, my utilization is 1/3, 10,000 over 30.
And so the lower the number, the better.
The lower the utilization, the better. So when you add more credit, you increase the total amount available. So if you don't actually borrow anymore, that will improve your utilization. It'll go down because you've got a higher denominator.
Okay, so we're going to come back to that because that kind of makes sense, right? So that would be the answer to the question. Oh yeah, the more credit, the better. But again, it's a little more nuanced than that. Okay, so what's on your credit score? Payment history, credit utilization,
and the history. So how long have you had the credit? The longer you've been in the system, the more accurate the information they think they have for you is, so the better that will affect your rating.
I know what the viewer is saying. The viewer is saying, wait a minute, number one was history and number three is also history?
So number one is your immediate payment history. How often or how frequently do you pay your bills? Do you pay them on time? Number three is how long have you been paying these bills? So, as you know, I'm fairly old.
Yes,
speak up, everybody.
Yes, you are.
In my 60s now, so I've had a credit rating for a very long time. So that's worth more when you're considering things than somebody who's 18.
Just thinking about that, the age of the people on this podcast is well over 120.
If you add them together.
When you add them together, yeah. So you're right. If I've had a credit card for 10 years, then that gives my credit score more weight than if I had it for 6 months.
Correct.
That's what you're talking about. Okay, so payment history is paying your bills on time. That's the recent history. Utilization, we talked about. Length of the credit history. Okay. What's number four?
So the next one is a type of credit. So having a mix of different credit vehicles is better than having it all concentrated into one or two things. So you could have credit cards, you could have lines of credit, you could have personal loans, you could have installment loans, any of these things that are reporting.
Mortgage, car loan, all sorts of things. And so what's your theory on why a mix is better than just having one?
Well, a mix shows that you have the ability to handle more than one credit vehicle at a time. So I'm making my mortgage payments, I'm making my car payments, I'm keeping my credit card up to date, as opposed to all I've got is one massive credit card or line of credit that I use all the time.
Yeah, I guess a mortgage or a car loan is the easiest thing to manage because the payment comes out once a month.
Right. They just take it.
Yeah, that's right. They just take it. Whereas if I've got 3 different credit cards, they've got 3 different payment dates. I got to make sure I'm managing to hit them all on the correct dates and so on. So, okay, so type of credit used, and then what would be the 5th component of it?
So the last one is how new is your credit? So, I mean, we were talking earlier when we talked about utilization saying having lots of approved credit is good. if you don't use very much of it. Your utilization is better. But the credit reporting system doesn't like it if you go out and you apply for a bunch of new credit cards over a short period of time. So, last month I got myself a new Visa and I'm getting a new MasterCard. Next month I'm going to try and get an American Express. Well, suddenly my credit profile's changed dramatically because I've added all this new potential credit, which could be turned into debt.
Right, which all links into the whole history thing. So,
right.
Okay, so to review what you just said, the 5 basic components: payment history, that's about 35%, credit utilization, about 30%, length of credit history, only 15%, and the final 2, roughly 10% each, the type of credit used and the new credit. Now, again,
somebody out there is going to, it adds up to 100 people.
Yeah. Did you do that math? 3, 6, 7, 8, 9. So now, whether those numbers are right or not, we don't know, because you cannot go on Equifax or TransUnion website and they say this is exactly the formula and this is kind of our best guess.
Well, and I'm still a believer that we don't really use any of these numbers in Canada anyway. The FICO score, the Beacon scores are used because there's thousands of banks in the U.S. We got 5 banks in Canada, a couple of others, B-level ones, but it's not nearly as complicated here. The only reason they show you these scores in Canada is because you hear about them in the U.S. and you want to see them. So,
yeah, and if I was a bank, I would get all the data and I would use my own customer database to decide how to weight things, how to rank things. I'd have different factors.
And I certainly wouldn't tell anybody how I do that, because then you could game the system.
And that's exactly right, which is why we're doing this podcast, to teach you
to help you do
how
that.
to game the system. So, okay, so the question we're answering today is it true that the more credit you have, the better your credit score will be? So we went through these 5 elements. And so I think on the positive aspect of it, type of credit used, a mix is better.
Right.
So that would lead me to believe that if I have 3 different types of debt, that's better than 1.
Correct.
And that would therefore make my credit score higher. So that's the answer, that yes, the more credit, the better.
Yep.
The number 2 was credit utilization, and you already explained that. But maybe you can emphasize that point again. How does that factor into your credit score?
So the credit utilization calculation is how much debt do you have versus how much credit you've been approved for. And so the more credit you're approved for, if your debt level doesn't change, the lower your utilization will be. The lower the utilization, the better.
Right. So in your example, I had $30,000 worth of available credit and I was only using 10. If I go out and get another credit card with another $10,000 limit, now I've got $40,000 available. I'm still only using 10.
So now your utilization's dropped to 25%, which is better.
Better than 33. So, okay. So in those 2 examples, more credit appears to be better.
Right.
There must be a downside to all this.
There's always a downside.
So let's go through. I've got 5 things that I think are a downside to all this.
Okay.
The first one being your debt to income ratio. So explain what that is, and then we'll try to figure out if it's how it affects this.
Well, so the debt number is how much money do you owe people? Your income is how much money do you make? And so relatively speaking, your debt to income ratio is how much debt have you got for every dollar of income that you earn? And the higher that debt number, the worse off you are.
Yeah. So if I've got $1 million mortgage, but I make $10 million a year, no big deal. If I got $1 million mortgage and I make $20,000 a year, I got a big problem. And I don't want to get into the specifics of, well, is a mortgage included in your debt to income ratio? Let's just go with the big picture. How much debt and how much income do you have to support it? So if I have more debt, more loans equals more debt. And so if my income is stagnant, that's not good.
Right. And in fact, that's what I think is going on in the economy right now. People are incurring more and more credit card debt and other types of debt, so that their debt to income ratios are deteriorating. You got more debt, but no more income. That's bad.
Yes, every year in our year-end predictions podcast, we predict that debt will go up.
and every year we're right.
And every year right. Now, there was a blip there in 2020.
Don't talk about that.
But when you look at go back 20 years, it's pretty much a straight line. So unless your income is going up faster than your debt, you got a problem.
Right.
Okay, so what is a hard inquiry?
So the credit bureaus keep track of everyone that takes a look at your account. And the reason for that is they're looking to see if there are trends. Are you applying for credit all over the place? A hard inquiry is when somebody you've applied for new credit, and so they're putting a record on the system saying you applied for new credit from us today. And the reason they put those there is so that anybody looking at your bureau could say, well, wait a minute, the last 3 weeks you've applied for 4. I mean, what the hell's going on here? A soft inquiry would be, say, if you personally took a look at your credit report. So the only one that knows that you've looked at your credit report is you. It shows in the history, but it doesn't show for anyone outside of you.
Yeah, I can check my credit every day if I'm that obsessed.
And there are people that
and
do
there
that.
are, and I certainly don't recommend it, but it's not going to lower my credit score if I'm looking at it.
Right.
The other example of a soft inquiry is somebody you already have a loan or a credit card with will be doing routine checks. So
right.
I don't know if this is true or not, but a VP at one of the big banks told me many years ago that every 3 months they do a soft hit on every single one of their clients.
Yeah, I don't believe that.
And well, with computers, I guess they could. And the reason is to see, has anything changed in your circumstance? Exactly what you just said. So if for the last 5 years, I've had 3 credit cards and I've basically paid them off every month, and now all of a sudden I got 6 credit cards and my utilization is close to 100%, I'm still making the payments as agreed on my credit cards, so there's no flags yet. But by doing that soft inquiry, the bank can go, whoa, wait a minute, something's going wrong. Before we started recording this, and our clock is broken, so it's always 22 minutes after 11 now, apparently. But right before we started recording this, I talked to a gentleman who said, oh, yeah, I had a credit card with one of the big guys with a pretty big limit, and last week they lowered my limit from like $30,000 down to $5,000.
Right.
And I said, that's interesting. And oh yeah, my payments are all up to date. I make them. So I wonder why they did that. Well, it's because they did a soft inquiry on him.
Most likely.
Because he told me the reason he was talking to me is, well, I got a whole bunch of other debt so even though that one credit card was still fine, they found out about it. So, okay, hard inquiries means you have applied for
new credit.
The more hard inquiries there are, that may lower your credit score.
And the rule of thumb we used to tell people was if you have 2 hard inquiries and they both rejected you for approval, you shouldn't do anything for at least 3 to 4 months because the third one is really going to kill you.
And again, we're making this up. We don't know. We don't have, but it kind of makes sense. Now, the exception to that rule would be, and you're a car guy, so you would know this. So a guy wants to buy a new car. So he goes to, I don't know, the Guelph Auto Mall,
sure,
where there are, 5 different dealers all in a row?
At least.
And so what do? Well, you go from dealer to, okay, let's see who will give me the best deal.
Right.
So it's quite possible that in a 1 day period, you could have 5 different inquiries.
You might.
And I believe the algorithm goes, oh, okay, we understand what's going on. You're shopping for a deal. It was all done in the same day or a couple of days. Clearly, you hadn't been rejected for anything yet, and maybe you got accepted at all of them.
Right.
So it's not a hard and fast rule.
Yep.
I certainly wouldn't recommend that if you're going for a car loan, well, I'm only going to one place and then I'm waiting 3 months to go to another place. But in general, you apply, you get rejected, that's going to hurt your score.
Well, and if you're nervous about it, they can do a soft look before they do the hard inquiry anyway.
Yeah, and I guess this is why we tell people, well, pull your credit report yourself.
Right, it's free now.
Yeah, and if there's stuff that's error on it, get the errors fixed before you apply for something so that you won't get rejected. You increase the chances. So there are some obviously things you can do about this. Okay, so we're talking about the downsides here of having too much credit. Screws up your debt to income ratio. Bunch of applications with hard inquiries that you get rejected on. Utilization, again, we already talked about that.
Right.
So on the surface of it, if the amount I'm borrowing stays the same and the number of debts I have goes up, my utilization goes down, that's good.
Yes.
But of course, there's a downside to this, which is, I've got more credit.
Right.
I'm going to borrow more.
Yep.
That's where it backfires on you. So you got to be very conscious of that.
Always remember that credit is considered good, debt is considered bad. So as soon as you convert that approved credit into debt, we got a problem.
Yes, and I've always believed we should call them debt cards, not credit cards, but we won't have that discussion here today. Okay. We talked about history. So point number 3 on your list was the length of credit history. The longer the credit history is, the better. So is it therefore logical to assume that if I have a bunch of new credit cards, that lowers the average age and therefore potentially impacts my credit score?
Intuitively, that makes sense.
Whether it does or not, we don't know. Again, we're speculating. So as a planning point here, so let's say you've got a credit card from ABC Bank.
Okay.
And it's the basic card. Okay. And you've had it for 40 years.
Right.
Because you got it when you were a young man.
Yep.
And the bank says, Ted, you're a great guy.
I'm not young anymore?
You're not young anymore. I believe once you hit the age of 27, you're no longer young.
Gotcha.
So we think you're great. You always make your payments. So we're going to convert your card to a gold card, platinum, molybdenum. Black. We're going to be a black card, whatever the coolest thing is now.
Right.
That has the potential to negatively impact your credit score if they cancel one and replace it with the other, does it not?
It does, particularly, I mean, if it's a complete cancellation, so you've got the old numbers gone and now there's a brand new number, so there's no connection between the two.
Yeah, so in that case, I don't know what you do. Like, do you say, okay, keep the old one open, maybe you reduce the limit on it or something, but that way I'm maintaining the history?
The old one will stay on your report for up to 7 years, as long as the ABC bank keeps reporting it. But it's not going to have the same impact as this new one.
Well, and if they cancel that card, then they report it as closed. That's fine. You paid it in full. It was all good.
Right.
But now that history that was supporting it is gone.
Well, and there's another aspect of this as well. Anytime you close an account, you take a hit on your credit report.
For the same reason.
Right.
Yeah.
Basically, you're reducing your utilization available.
Well, and so you got your car loan. It's a 5-year loan. At the end of it, you pay it off.
Right.
That potentially has a negative impact on your credit score.
It could, yeah.
Because now your utilization has gone down. I mean, utilization is more of a concept for credit cards than car loans, but there was credit there.
And now it's done.
Now it's gone. Now, of course, there was debt there, and it's also done. This is where it gets a little confusing. Okay, the obvious one that screws up your credit, this is Department of Obvious Department, missed payments.
Right.
So the more accounts you have, the more likely it is you're going to miss a payment because you're trying to juggle 15 different things.
Well, and given the way that our, let's say, mail system has been working the last year or so, the odds of missing something in the mail, so just about all of us probably have one missed payment in the last 3 months.
Yes, and so what we all did, and of course I did this years ago as well. I'm going electronic.
Right.
I'm going electronic. Okay, well, it used to be something came in the mail. Oh, that reminds me I got to pay it. Well, now what's the reminder?
Right.
I've got one credit card that sends me an alert every 15 minutes. Oh, you're getting close to your limit. But then there are others that maybe you don't have alerts set up. You got to check whatever.
Right.
So I think it is actually easier now to miss something.
I think you're right.
And it's not just the credit card. It's your hydro bill, gas bill,
anything.
Whatever.
Right.
So it used to be I got a piece of paper. Now I don't get the piece of paper. If I'm not getting the alerts, I could get into trouble.
Right.
The point is the more accounts you have, the more likely it is you're going to miss something.
Makes sense.
Because again, if I got 3 credit cards and the payment dates are 3 different dates, then I've got a risk of getting into trouble. Okay, so now it's called story time.
Okay.
I'm going to tell you a story that this is all made up. This is not a real.
It's a made-up story.
This is a made-up story.
Fiction.
But when
once there was a government in Canada that helped all Canadians. So wait a minute, that's not the story.
That would obviously be fiction. So, and this story, everyone's going to go, okay, well, this is obviously a real story. Yeah, because this is based on a true story.
Right.
Joe was unemployed for a while, used his credit card to survive. Okay, that happens all the time.
Makes
Then
sense.
he got a new job. Great. He needed a car. So to improve his credit score, he applied for 2 new credit cards before he applied for the car loan, hoping to improve his credit score because utilization, all those things we just talked about. It didn't work. His score dropped, and he ended up paying a higher interest rate on his car loan. That's a tangible example of the risk of trying to play this game,
right,
of jacking up the number of cards that you've got. Is there anything he should have done differently in that scenario? I mean, the obvious thing is, well, okay, if you're going to get the cards, get them well in advance of when you need the credit.
Well, and so I think before he applied for the cards, he probably should have gone in and talked to somebody at the bank to say, can we do a soft inquiry? Am I likely to get approved for a car loan? What do I need to do that? And the bank would say, well, I'm thinking about getting a couple new credit cards. Oh, don't do that. That would be bad. Maybe you should get one or maybe something else. The bank will tell you the things that they would like to see.
Yeah, because they're the ones who are granting the credit. So I think the most obvious thing, and we already talked about this, get your credit report.
Right. Have a look.
Like you said, they're free. Mm-hmm. You can set up an account with both Equifax and TransUnion. And we're not talking about the $20 a month plan.
There's no fee for these things.
You don't have to. I mean, what you get with the $20 a month plan is you get access to your credit score as well as your credit report.
Right.
And as we've already said, your score is different no matter which bank you're going to. They all come up with their own algorithm.
Right.
What's most important is you don't want to have errors on your credit report.
Mm-hmm.
So if you have a credit card that you already paid off, but it's still showing as a balance owing, well, you want to get that corrected.
Right.
So my advice to Joe and anybody else would be, okay, number one, get your credit report from both TransUnion and Equifax,
right?
Because you don't know which lender they're using.
Right.
And thanks to the marvels of modern computers, you can actually go right online and submit your, okay, this is wrong, fix this, fix that.
Right.
Because you remember, 5 years ago, before all the events of 2020, you would mail in your application to get your credit report. It would come back.
Eventually.
You'd send eventually if it got there, and then you'd have to fill it out. It would take, a month or 2 or 3. Now, we've got lots of reports that within a couple of weeks, errors can be corrected.
Right.
So get your report online, make the corrections. Advice number 2, space out the applications then.
Mm-hmm.
And this solves your hard inquiry, soft inquiry, all that kind of thing.
Right.
So if you were buying a car, and you've never bought a car in your life because you believe in
not
walking,
this week anyway.
Not this
right.
week. So how would you do it? Would you, and assuming you're financing it,
right?
Would you go from dealer to dealer, or is it I'm investigating the kind I want? Or
well, so I try and shortlist what it is I actually want to look at first, and I look on the internet to see which ones are offering promotions. Where can I get the best deal, and do these deals coincide with any of the brands that I'm actually interested in? So I do a lot of homework online before I actually get anywhere near a car dealership, because you got to remember the guys selling cars. Each of these guys sells, 5, 6, 10 a week. All the power in that transaction is with the salesman. You buy a new car. Well, if you're lucky, you get a new car every 4 or 5 years. And so these guys, they got every trick in the book they're going to throw at you, because they got so much more power in this transaction. So arm yourself before you go to a car dealership.
I haven't bought one in 12, but I understand your point. So, okay, but there's 2 elements to that. One is, what kind of vehicle do I want or need, or what are the deals or whatever? And then the second is, how am I going to finance it?
Right.
So do you talk to your bank about financing before you go to the dealership, or is the dealership going to have better financing deals because that's really the business they're in?
Yeah, it depends on the time of year. The dealership is almost always going to have a better interest rate program than a bank, because that's the business that they're in. And they make more money off of financing your car than they probably make off of the damn car. So they're in the business of selling you that loan, whether it's a lease, a loan, finance, whatever it is. But you should still, again, online, before you do any of this, find out what the going rates are, find out what the promotions are, so that you've got an idea of, well, this is what it's going to cost me, and make sure you're only talking to somebody about a car that you can actually afford. Again, the dealers are famous for, well, what do you think you want? Okay, well, if you get this, now why don't you look at this one? It's only a little bit more, and suddenly your payment's gone up $150.
Yeah, it doesn't matter what the car is selling for. It's how much am I going to have to pay every month, and for how long. That's a much better thing. And I think you're right that the dealership will have access probably to a better deal than the bank, because the bank only makes money off the interest.
Right.
Whereas the dealership wants to sell you the car, so they make money off the loan. I mean, they don't actually loan you the money; they're factoring it out.
And the banks all give the dealer their promotions for the dealerships to try and get their volume, because it's big business. Used to be the only bank that was really involved in car financing was Scotia. Now they've all got car financing lines. So it's when you're in talking to the finance manager, they're going to tell you who's ever got the best promotion this month.
And they would know, because like you said, they're selling 10 cars a week. And so they are constantly shopping the market. And then, of course, the dealer wants to sell you that car, because the more cars they sell, the more of a discount they get from the manufacturer. Right. And then you come in for your oil change every 6 months for the next 5 years or whatever. So you're going to get the better deal there. But you hit on, I think, the second and critically important point, which is don't overextend yourself.
Right.
You got to know your limits.
A man's got to know his limitations, right? Talk to Clint.
Exactly. So if I can afford X number of dollars a month for my car loan, that's it. That's the number.
Right.
You can't go over that, and that way you can't get into much trouble. And then I think the third component to all this, and again, we're trying to answer the question, is more credit better? Well, you made a distinction between credit and debt.
Right.
reducing your debt is probably
good.
Critically important.
Yep.
And so I want to manage my existing debt. I guess there's a bunch of ways I can do that. One would be through a consolidation loan.
Right.
If I got a bunch of high interest credit cards, can I turn it into a loan at a lower interest
They're hard
rate?
to get approval for, but yeah, you should look at that first.
Yeah, the market is tight right now. And if I'm the bank and I'm charging you 20% on your credit card, do I really want to give you a loan at 10% to consolidate it?
Well, and it's worse than that is you've got 3 credit cards. One of them's with the bank. Why would the bank want to lend you money at a lower rate to pay off other businesses' debts?
We don't want to take on somebody else's problems.
Right.
So consolidation is one answer. Canceling unnecessary cards, well, that may have a negative impact on your credit score in the short term,
Right.
but it also keeps you out of trouble.
Yep.
So I'm a big believer in not having 47 different credit cards. I think that's wholly unnecessary.
Correct.
Maybe 2.
One for personal, one for business, or maybe you need one to track things for tax purposes. I mean, any more than 2 and you run the risk when things go wrong, you can run them up.
Yeah. So it's great that you're juicing your credit score by having all this authorized available limit, but you can get into trouble. And then, of course, the final solution, if I've got way too much debt, and that's what my problem is obviously what we do, a consumer proposal,
Right.
where we go to the people you owe money to and say, look, I can't afford to pay you back in full. Just can't do it.
Yep.
So I'm going to make a deal. I'm going to pay half of it back, a third of it back, whatever the magic number is based on your income and assets and so on.
Mm-hmm.
That's going to have a negative impact on your credit score,
It will.
but it's in the short term.
Right.
Once the debt is eliminated, then you can begin the process of rebuilding. So how then do you decide if taking on another loan is worth it? What's my thought process?
Well, so what do you gain? What is it that you think you need the loan for? And do you really need that thing? Or do you need so let's use the car example again. Do you need that particular car? Could you get by with less? Can, put some money in the one you have and it'll last longer? So what's the money for, right? I don't think it ever makes sense just to borrow to try and increase your credit score. If I thought about it, I could probably come up with a hypothetical, but as a general rule,
yeah, I completely agree with that. As
Yep.
a general rule, you should do what's right for you.
always.
So playing this game of, well, my credit score is 720 and I'd like to get it up to 740. Okay, I understand that maybe an incremental increase in your credit score makes borrowing cheaper. Maybe it's a little easier to get an apartment or whatever. But if it means you've got to juggle 4 different credit cards and this and that and do these other things and put yourself at risk of that, I would lean more on having less debt. Like if you want to be able to rent an apartment and your credit score is low, okay, well then work on increasing your income, reducing your expenses, trying to save a bit of money so you got a bigger security deposit.
Right.
Get your debt level under control. That's far better because that's better for you. You're paying less in interest than trying to game the system with all these wacky things.
We say this on just about every show. The only one who's really interested in your financial well-being is you, right? Anybody else is trying to sell you some kind of product.
Well, and who's the credit score really for?
Right. Well, it's for the lenders. It's not for you. You are the product. You are not the purchaser.
You are the product. If you're not paying for it, then you are the product. That's exactly how it works. And maybe someday we'll do a show on whether or not the credit reporting system incentivizes or penalizes borrowers for using credit responsibly. It's an interesting discussion. But there's no doubt that guy with 4 credit cards may actually have a better credit score than the guy with 2 if he's playing the game right.
Yep.
But I think it's just too big a risk, and therefore I don't recommend it. Make sense? So there you go. The credit score is for the lender, not for you. Do what's right for you.
What was your original question?
The original question was, is it better to have more credit? Will that improve your credit score?
Right.
And the answer is maybe, but it's far more better.
Far more better?
Far more better. Hey, this is why I'm a professional at this
That's
podcasting thing. It's far more better to have savings, keep your debt levels low, don't worry about all the other stuff.
Exactly.
So there you go. Our firm, Hoyes, Michalos and Associates, which was named after Doug Hoyes and Ted Michalos, 26 years ago, I believe it was. We're on all the social media platforms. Well, you and I are, because we don't know how to work TikTok and Instagram.
Somebody puts us there.
Yes, Morgan knows how to do all of this. So if you'd like to share your thoughts on what we've discussed today, you can use the hashtag DebtFreeIn30, because that's the name of our show, right?
Right. Yep.
Debt-free and the number 30. If you're watching on YouTube, please join the many thousands of others who've already subscribed to the channel. Please like, share, notification, you know the whole deal. And again, you can leave your questions or comments there because we want to hear from you. Most of you are not watching us. I don't know why, because we're beautiful. Or maybe that is the reason. You're listening on Spotify, Apple Podcasts, whatever. So again, thanks for listening. Please like and subscribe. That is our show for today. Until next week, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.